Alright, welcome everybody to another video on the After Hours channel. For those of you that don't know, my name is Anthony. I'm a long-term investor with a passion for money, stocks, and personal finance. On this channel, I'll be sharing my insights and experiences as I track the performance of my dividend portfolio. I believe in the power of long-term investing and want to show you what it's like to be a long-term investor in today's market. Whether you're just starting out on your investing journey or you're a seasoned pro, I hope to provide valuable information and resources that will help you make informed decisions about your money and investments. Join me as I share investment strategies, discuss current market trends, and provide tips and tricks for managing your personal finances. Subscribe to stay up to date with the latest from the After Hours channel, and let's build our wealth together. Alright, welcome everybody. Glad to see you guys all back. This video is going to be solely dedicated to value traps. But before we get into the main portion of this video, I just want to say that this is going to be episode 12 of Road to 1 Million. If you guys are unfamiliar with what that is, I'll be tracking this portfolio that you see on your screen right here all the way to $1 million. You'll be able to see my trades, which are weekly, my dividends in a six-figure portfolio, and I'll also be giving you guys a heads up on which companies I'll be buying in the future. Doing a quick portfolio update before we get into the main part of this video, and you guys can see that year to date the portfolio is doing really well. Honestly, I couldn't be happier. Portfolio is currently up 21% and sitting at $124,000. If you guys are wondering how I got such a return like that, it is mainly due to two different companies. What are those companies, you may be wondering? Well, the first one is Microsoft. I just made a video about it. I'll put it in here so you can click and go watch that if you would like to. And the second company that has attributed to a lot of my success this year is also Apple. Now, jumping into the main part of this video, today we're going to be talking about a critical topic for investors, and that is, as I mentioned, value traps. These are stocks that may look cheap at first glance, but can actually lead to disappointment and losses. So, if you want to avoid falling into this trap, stick around. Before we dive into some of the companies that I have labeled value traps in today's market, we have to first understand what a value trap even is. So, if we take a look at Google, it says a value trap is a stock that looks like a great deal but isn't. The stock may look like a bargain because the company is trading at low multiples and metrics like price to earnings or price to cash flow or even price to book value. Now, I think this is a good definition, but I think it's leaving a few things out. When we're discussing value traps, there may be underlying issues that make the stock less attractive than it seems. Sometimes those underlying issues are not the price to earnings, the price to cash flow, or the price to book value. Now, the first example of a value trap on our list is going to be General Motors. So let me just give you guys a warning. If you hold any of these companies, I hope you don't get offended at this. I hope you look at it from a third-party perspective and use some of the information and knowledge I'm going to provide today to make informed decisions about your investments or one of these companies. With that being said, this is not financial advice, so if you do own one of these companies, I'm not telling you to sell it. This is just my own personal opinion that you can use to make your own informed decisions about. So, first on the list, the first red flag to watch out for is declining fundamentals. Just because a stock price is low, that does not mean it's a good investment. Look beyond the price and examine the company's financial health. Is the company experiencing consistent revenue and earnings growth, or are these metrics on a downward trend? Declining fundamentals could indicate underlying problems. So, with General Motors in mind, let's take a look at a few things that typically resemble a value trap. Taking a look over here at the value section, we can see that General Motors is currently trading at a PE of 4. That is extremely low. So a lot of investors may see that and ultimately jump into the stock without doing any other research because they think it's undervalued. If we take a look at the price to book, it's 0.83. That's also not a good sign. If we move over and we take a look at the balance section real quick, we can see that on hand they have $28 billion in cash and they are in debt $77 billion, which nets out to negative $49 billion. Now let me ask you a question. Would you want to invest your money in a company that is in debt almost $50 billion? Taking a look at some of the actual fundamentals, let's jump into the revenue. As we can see, the revenue has been pretty stagnant since 2008. In 2008, the revenue was $148 billion, and in 2022, the revenue is $156 billion. If we look down here at the bottom, we can see that over the last 10 years, their revenue increased 0.29%. That is extremely low. Keeping an open mind though, let's take a look at their EBITDA. So as you can see, their EBITDA does not look any better than the revenue. Consistently flat over the years. If we take a look at the company's cash flow, we can see that it is actually negative. In 2022, General Motors actually lost $5 billion. Now, if we include stock-based compensation to their free cash flow, we can see they actually paid $0 in stock-based compensation. So even though they lost $5 billion, and I'm not saying this is a good investment, at least they're not paying their executives huge compensation when they're still losing money. If we jump down and we take a look at shares outstanding, we can see that General Motors has been issuing new shares, which is diluting you as the shareholder. Yes, they've done some buybacks, but totality of the circumstances, and if we're looking at the past 10 years or more, they've always maintained a high share count and they've increased it at times. Taking a look at return on capital employed, we can see that it is not very good. In 2022, they had a return of capital employed of 5.97%. That ultimately means that if General Motors invested around $100, they got $5.97 back in return. So therefore, they are not the best at managing money and investing money to get a large return on that investment. For instance, a lot of companies in my portfolio that I hold now have returns on capital employed upwards of 30%, sometimes 60%. The second warning sign is excessive debt. Companies burdened with high levels of debt can be risky investments, even if their stock price appears to be cheap. When a company has significant debt obligations, it can hinder the ability to invest in growth, service the debt, or adapt to the market changes. Always pay attention to a company's debt to cash ratio and overall debt levels. Here are a few examples of companies with substantial debt. While their stock price may seem attractive, the weight of their debt can be a significant burden. In such cases, it's critical to assess the company's ability to manage and reduce its debt over time. So taking a look at Ford, we know that this company has historically always had a high trading volume. It's not uncommon for a lot of people to buy into the stock because, as you can see, it's trading at $12. Uninformed investors think that they're getting a deal because they're buying a company with such brand value like Ford, when in reality, they have never looked at the financials of this company. So, speaking of financials, let's take a look at the valuation for Ford as well. Their PE ratio is currently 9, which again is very low. Their price to book is 1.2, which is not the best as well. Jumping over to the balance section, we can take a look at how much debt this company has. So cash on hand, they have almost $40 billion, but they are in debt $91 billion. That nets out to negative $51 billion. Now, while we're on the topic of value traps, another thing I definitely advise everybody to take a look at is the dividend yield. When you have a company like Ford that is in debt $51 billion with declining revenue and free cash flow, and they're paying a dividend yield of almost 10%, that is a huge red flag. Not to mention, if you take a look at the payout ratio, it's 76%. That is extremely high. Make no mistake about it, that is a way to entice investors to buy into the stock. Now, taking a look at some other financials, let's jump into free cash flow. As you guys can see, Ford's free cash flow has been pretty stagnant since 1988. If we take a look at last year, 2022, you can't even see a graph there. They actually lost $13 million last year. Now let's include stock-based compensation to see if they're diluting us as the shareholder by paying their executives and employees stock while they're losing money. So if we include the adjusted free cash flow, which incorporates how much they paid in stock, we can see that they actually lost $350 million last year. Taking a look at the shares outstanding, we can see that Ford issues a lot of new shares. They have been diluting shareholders for a long time, since 1985. Now, it's not always a bad thing if companies issue new shares. I don't want to give off that impression. But when you have a company year after year for decades consistently issuing new shares and diluting shareholders, and they're not bringing in any money, their free cash flow is in the negative, that is a red flag. Lastly, I want to take a look at the return on capital employed for Ford. We can see that last year they had a 7.8% return on capital employed. If we go to this 10% mark, we can see that Ford typically does not go above a 10% return on capital employed, which again is not necessarily a red flag, but it's something I would take into consideration when looking at all of their other financials. So based on everything we saw, this is not something I want to see. Checking out one more example of companies that are in massive amounts of debt, we're going to be taking a look at AT&T real quick, and we'll be coming back to this one to look at the financials. But first, I just want to highlight the balance section on this company. AT&T has $2.8 billion of cash on hand, but they are in debt $123 billion. That nets out to negative $120 billion. So when I tell you guys, make sure you know what you're buying into, you understand what a value trap is, and that debt can play a crucial factor in whether your investment performs well. This is an example of that. The third factor to consider is industry disruption. Industries experiencing rapid technology advancements or shifting consumer preferences can leave certain companies behind. When evaluating a stock, analyze the industry's future prospects and the company's ability to adapt and stay competitive. Here's one example of one of those industry disrupting companies I was referring to. Companies within these sectors may appear cheap, but they could be value traps if they fail to keep up with the changing trends. As an investor, it's critical to identify industries with long-term growth potential rather than those in decline. So for this example, I wanted to highlight Teladoc. This is actually a company I used to own a few years ago, and I wouldn't say it's necessarily in a sector that's declining, so pharmaceuticals, but it is a company that came up rapidly. It had a lot of hype behind it, and then like many other companies during that time, it had a fall from grace. So when we're talking about value traps, this is another company that I want you guys to keep an eye out for. So as we can see, Teladoc is currently trading at $23. We take a look at the value section, we can see that their forward PE is 357. It's not even giving me the actual PE right now. Taking a look down even more, we can see the price to book is 0.75, which again, not something I want to see. Moving over to the balance section, we can see they have on hand roughly $888 million, and they are in debt $1.5 billion. So that nets out to negative $647 million. So if we reference back to their price chart of this company, that fall from grace I was referring to is right here. 2021, the price of this stock was actually $290. As we just saw, the company is now trading around that $23 mark. If you happen to be one of these investors buying in at the top, you may have lost all of your money. That's why I constantly repeat, it is important to know what you are investing in. Don't jump on the hype train because you may be that investor that buys at the peak and lose everything. So if we take a look at the revenue for this company, it actually looks pretty good. 2022, the revenue was $2.4 billion. Now, if we compare that revenue to their free cash flow, there is a drastically different story being told. In 2022, this company only made $16.5 million. Now, if we include stock-based compensation to that factor, we'll probably get a different story as well. So not only did this company make $16 million last year, which is nothing for a company trading at the market cap it is, but they paid their employees and executives $217 million in stock. If we change this to the adjusted free cash flow, they actually net out in the negative every single year. Since 2013, they had a negative free cash flow because they are paying their employees in stock-based compensation. Last year, they actually were negative $200 million, not positive. Again, another example of a value trap. It appears as though the company is profitable when in fact they are not. While this company is paying its executives and employees in stock while losing money, they are also issuing new shares, which is further diluting you as the shareholder. It is making your shares in this company worth less and less. Lastly, beware of companies with questionable management. Even if a stock seems undervalued, poor leadership decisions and management controversies can negatively impact its long-term prospects. Investigate the company's management team, their track record, and their ability to navigate challenges effectively. So when we're talking about poor management, this is just an article I wanted to pull up. I'm not necessarily saying that the Ford CEO is in this category, but it's just an example of what I'm trying to highlight, as in leadership's decisions can drastically affect the trajectory of a company. So if we take a look at this article right here, it says the Ford CEO, Jim Farley's frustration builds as he vows to transform the automaker. If we jump in and we take a look at some of the key points, we can see that it says the CEO, Jim, wants Ford to become a far more effective company and he needs it to happen quickly. So make no mistake about it, he is saying that his executive team is not doing what they need to do. Therefore, changes need to be made. He goes on to say we have to change our cost profile. We know what we have to go after. And this is after the Detroit automaker missed analyst expectations by a wide margin due to another quarter in which cost and supply chain issues hurt the bottom line. So if you're an investor in Ford, that may not seem like an immediate big deal. You have the CEO saying, hey, we know there are issues in our company and we need to change them now. But even though they understand the challenges that they face, that is still costing shareholders money. As you can see, this is after they lost $2 billion in 2022. So even though they understand the challenges they are facing, you are still losing money as the shareholder. It's not good optics. Now, jumping back to AT&T, which is going to be our final review of financials and just the culmination of value traps, and that is a company that is trading at $15 per share. So again, that's not really a lot of money. And if you don't know what you're looking at, that can cost you even more. Taking a look here at the valuation, their PE is currently 11.5, so very low, and their price to book is 1.1. As I mentioned previously, the balance section, they are negative $120 billion in debt. And that dividend that I was talking about is actually 7.1%. So they're paying a very large dividend payment when they are hemorrhaging money. Look at the payout ratio. It is 81%, which is extremely high and risky for this company. Not to mention telecommunications typically do not perform very well. Taking a look at their adjusted free cash flow, we can see that the free cash flow has actually been dropping since 2019. It had a run up, but now is dropping. So in 2022, they actually made $12.4 billion, and that is including stock-based compensation. Taking a look at the outstanding shares, we can see that it has a similar story to most of the other companies we looked at today. AT&T has consistently been issuing new shares, therefore diluting you as the shareholder. Your shares are worth less and less every time they do this. If we take a look at the return on capital employed, we can see that AT&T over like the last 10 years has truly been struggling to break that 10% return on capital employed. That is not something you want to see in your investments. So if we bring it back to where we started, remember, while a stock may seem cheap, it is critical to look beyond the surface and assess the underlying factors that can contribute to its valuation. Declining fundamentals, excessive debt, industry disruption, and questionable management are warning signs to watch out for. Doing thorough research and consulting with financial professionals can help you avoid falling into these value traps. Now, if you're like me and you don't want to go to financial professionals or you don't have the money to do so, you can always do the research on your own. That's why there are platforms like YouTube and channels like mine to follow, so that I can point you in the right direction or break down a company you may not fully understand. That's going to wrap up today's video. I hope you found this information useful. If you did, please give the video a thumbs up and consider subscribing to my channel for more valuable content. Always remember to do your due diligence before making any investment decisions. And if you have any questions about the topics we covered today, leave your questions in the comment section below. I will get to them. Thank you guys for watching. Take care.